Here's the thing. You've probably heard the same financial advice 100 times. Save 20% of your income, invest in index funds, and you'll be fine. Sounds simple, right? But here's the catch. Real life is messy. And most people fail, not because they don't know the rules, but because human behavior silently sabotages them. Think about it. Have you ever started saving, only to spend it impulsively? Invested a little and then panicked during a market dip? Followed good advice, but still feel behind financially? If that's you, this is where it gets really interesting. Look, here's what most people don't realize. Financial advice is simple on paper, but humans aren't rational machines. According to a 2021 Vanguard study, 65% of investors underperform the market because of emotional reactions, not lack of knowledge. Let's break it down with an example. Imagine you invest $1,000 in a stock. Market drops 20%. Most people panic and sell, locking in a $200 loss. If instead you ignore the daily swings and continue contributing monthly, that same $1,000 could grow to $2,000 in just a few years at a conservative 7% return. The key is that your psychology compounds just like money. Even small lapses in behavior, checking the market daily, lifestyle inflation, micro expenses, erode wealth silently. A $3 per day coffee becomes $1,095 a year, which is roughly $43,000 in 20 years. A $50 per month subscription adds up to $24,000 over the same period. Small habits either build or destroy wealth quietly. Meet Anna and Brian. Anna automates $500 a month into index funds, maxes tax-advantaged accounts, and ignores daily market news. Brian invests sporadically, reacts to trends, checks the market constantly, and makes emotional trades. After 20 years, Anna ends up with about $275,000 and Brian with $180,000. Same knowledge, same income. Behavior and consistency made a $95,000 difference. Systems and behavior beat intelligence and luck. Margin isn't just money, it's freedom. Catherine builds a $10,000 emergency fund. Market drops, she buys opportunities at lower prices. Her portfolio grows steadily. David has no emergency fund. Market drops. He's forced to sell, locking in losses. Small buffers prevent panic selling and allow compounding to continue uninterrupted. Even a $500 per month buffer prevents lifestyle creep and preserves tens of thousands over decades. Small daily decisions multiply into massive long-term differences. A $3 per day coffee, a $15 per week Uber, a $50 per month streaming subscription cumulatively impacts wealth quietly, adding up to nearly $99,000 over 2 decades. Tracking these micro-decisions weekly, not daily, reduces stress and prevents creeping financial leaks. Debt silently sabotages wealth. $5,000 at 18% interest with only minimum payments over 10 years costs about $4,800 in interest alone. Adding just $200 extra per month reduces payoff time to 4 years and saves $2,200 in interest. Alex ignores debt and spends windfalls, eroding wealth. Jenna automates payoff, adds small extra payments, and accelerates savings. Automation and micro habits outweigh willpower alone. Taxes quietly destroy wealth if ignored. Maximizing tax-advantaged accounts preserves tens of thousands over decades. Harvesting losses offsets gains, and reinvesting dividends compounds quietly. For example, $500 per month in a taxable account might result in $270,000 after taxes, but the same amount in tax-advantaged accounts could reach $330,000 tax-free. Small tax optimizations compounded over decades preserve tens of thousands. Humans compare constantly. Friends' vacations, colleagues' gadgets, family upgrades trigger lifestyle inflation. Ignoring social comparison and focusing on your system grows wealth faster than any income increase. Automating investments, debt payoff, and savings, building emergency and discretionary buffers, tracking micro habits weekly, reinforcing identity. I am disciplined and patient pre-planning major life expenses, and rewarding consistency instead of perfection create predictable wealth. Behavioral systems and consistency turn advice into real outcomes. Life stage planning matters. In early career, 20s to 30s, habit formation is more important than high income. Investing $300 per month at 25 could grow to about $170,000 by 45. The same amount starting at 35 only reaches around $84,000. Time matters more than money early. In mid-career, 30s to 50s, optimizing contributions, maintaining margin, and preventing lifestyle creep is crucial. In late career, 50s to 60s, the focus shifts to preserving wealth, managing risk, and tax efficiency. Major life investments can silently destroy wealth if unplanned. Overleveraging a home could cost $30,000, which is roughly $50,000 in lost opportunity over 20 years. Education expenses should be pre-planned to prevent silent compounding loss. Pre-planning major investments prevents creeping financial leaks. Micro habits across life stages create massive differences. A $3 per day coffee accumulates to $43,000, a $50 per month subscription to $24,000, and $500 per month lifestyle creep to $275,000 over 20 years. Behavioral discipline ensures micro decisions build wealth rather than destroy it. Advanced behavioral systems reinforce this. Automating contributions, debt payoff, and savings, building emergency and discretionary buffers, tracking microhabits weekly, reinforcing identity, and applying stage-specific strategies ensure predictable compounding and financial independence. Psychological resilience is critical. Humans are wired for short-term rewards, and loss aversion triggers emotional errors. Automation, identity reinforcement, and margin act as multipliers on financial growth. A $1,000 loss might cause panic selling and lock-in losses, but ignoring short-term swings and continuing investments could turn that same $1,000 into $2,000 over a few years. Psychology compounds like money. Your identity compounds like money too. If you reinforce, "I am disciplined and patient," your micro-habits align with long-term goals, leading to consistent compounding. Lisa tracks habits quarterly and ends up with $1.2 million. Alex ignores reinforcement and reaches only $750,000. Identity plus micro-habits outweigh knowledge alone. Time, consistency, margin, tax optimization, and behavioral alignment create exponential growth. Small tweaks like automating contributions and tracking spending produce massive results. $500 per month automated consistently might yield $240,000 over 20 years. Inconsistent behavior reduces it to $180,000, a $60,000 difference purely from behavioral execution. Risk tolerance is key. Overestimating your comfort leads to panic selling. Underestimating leads to overly conservative portfolios that miss compounding. Portfolio psychology matters. Chasing winners, anchoring on past highs, or following the herd destroys wealth. Market cycles don't destroy wealth, behavior does. Aligning your behavior protects both money and mental energy. Extreme case studies illustrate this. Alex, disciplined, accumulates $1.2 million. Brian, emotional, invests the same amount and reaches only $700,000. Micro decisions compound silently into extreme wealth differences. Success is quiet compounding. Failure is the accumulation of unnoticed micro errors. Motivation matters. Start small, even $50 per month. Track micro habits weekly. Reinforce your identity. I am disciplined and patient with money. Build margin with emergency and discretionary funds. Apply stage-aligned strategies. Tiny, consistent steps today lead to massive results decades later. Behavior matters more than knowledge or luck. Micro decisions silently build or destroy wealth. Automation, margin, and identity create predictable outcomes. Stage-specific strategies maximize compounding. Psychological resilience protects wealth and mental energy. Consistency compounds silently. Start now. Your systems, your behavior, your identity, combined with compounding, are the real keys to financial freedom. Even small adjustments compound massively over time. A $500 per month automated contribution, a $50 per week micro savings habit, a $3 per day coffee skipped, all silently add up over decades. Each tiny micro decision reinforced by identity and habit compounds just like money. Your portfolio grows, your confidence grows, and your long-term financial freedom becomes inevitable. Real wealth isn't about timing the market, chasing hot tips, or knowing every trick. It's about building a system, automating it, protecting it with margin, reinforcing your identity, tracking your habits, and letting compounding quietly do the heavy lifting. You don't need perfect decisions. You need consistent, aligned decisions. Start with small steps today. Automate, track, reinforce, protect, and grow. Over time, these decisions accumulate, and that quiet discipline becomes a mountain of financial freedom. Time is your most powerful asset. Use it wisely.